Hey everybody, good to be here. My name is Brent Moores and it's time for Advanced Options. This week we're going to continue our series of different options strategies. Today I'm going to kind of piggyback on some strategies we've already covered, namely calendars and diagonals, and expand and modify it a little bit to talk about double calendars and double diagonals. So that may sound intimidating. It's really not. If you do calendars or diagonals, it's just a minor little change to those, and we'll get through those in just a little bit. But hey, I'm glad you're here. Whether you're watching on a recording or watching live, that's good, and glad you're here, and I'm glad Barb's here too. Barb's helping me out in the chat. I always appreciate Barb. And if you haven't already, make sure you check out her Trading a Smaller Account class. And she does a really good job with that. And especially, I mean, I think everybody can benefit, but especially if you're one that doesn't feel you have a huge trading portfolio, that's a good class for you to check out. You can follow us on X at Brent Moore CS, at Barb Armstrong CS. Let's hit up our disclosures and then we'll get to the reason you're here. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation of any security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. And paper money application is for educational purposes only. I may not factor in commissions in all these trades, and we'll be talking about multiple leg trades today, and so there'll be multiple commissions involved with these things. So be aware of the fees on these. And all investing involves risk, including potential loss of principal. There, short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and there's no guarantee a stop loss order will be executed at or near the stop price. Okay, there we go. Let's head on over to the markets. Here's the Thinkorswim desktop software. This is the S&P 500. Last week in this class, we discussed how I think we were right about here, and we were saying, well, this has gotten pretty frothy. It's gone up a lot. Wouldn't it be surprising if we had a little pullback? Well, we've had a little bit of a pullback. Key levels, probably this level right here, I would consider probably to be a decent support level. It was a prior resistance level that we bounced off multiple times. If we were to take this level right here, I'll try and keep my line as straight as possible. That's kind of right where we're at. There's a potential support that coincides with that 20-day moving average. And then in terms of this level where we bounced off of, essentially, that's a potential resistance level. Now, it doesn't mean you can't go through a resistance or a support level, but that's kind of what we're looking at in the market right now. Obviously, some of this is going to be just driven by market data, what comes out. We had a little bit of a spook in the market here, I guess, this morning with more talk on tariffs and their implications, and it knocked the market down. But we're actually down only about 1/3% right now, and you can see on that candle we're right near the high of the day. We gapped down, so market is recovering a fair amount right now. So that's just a quick market overview here on this. And I want to, so this is what I want to do today. I want to talk about calendars and diagonals, okay? Just a quick, super brief review of calendars and diagonals. Then I want to focus on double calendars and double diagonals, okay? And then I want to actually place trades on double calendars and double diagonals in the market. These are paper trades. They're just example trades. They're not recommendations, but in order to familiarize yourself with those. So there we go. Let's take a look here at that. Basically, when we talk about calendar spreads, we are talking about, and just a quick reminder as we look at this, with calendar spreads and diagonal spreads, I'm assuming you have a basic level of knowledge in the market. This is more of an intermediate to advanced class. So the basics are, I'm going to assume you know some of the basics, but I encourage you to stick around even if you're pretty new here to try to gather what we're talking about here. On a calendar spread, you're selling a contract and you're buying a contract, same strike price, different expiration dates. Generally, we're going to sell the near-term contract, we're going to buy a longer-term contract, and the risk profile for that is going to look something kind of like, let me just draw out my risk profile tool here, okay? A risk profile for that is going to look something kind of like this, okay? That's going to be that's your kind of typical calendar spread risk profile, right? This would be, and this would be the strike price that you choose right there, wherever that is. And we'll show you in real life on this what that looks like. Diagonal spread, so we'll say we do a kind of a bullish diagonal. It's probably going to look something like this. And the difference between that diagonal spread and the calendar spread is there's a lot of similarities. We're selling a near-term expiration, we're buying a longer-term expiration, but different strike prices. Okay, so that's kind of what a diagonal spread looks like. If you'd like to review calendar spreads or diagonal spreads, I did diagonal spreads last week in this class. So if you look at the playlist in this class, last week I did diagonal spreads. A couple weeks before that, I did calendar spreads. So there you go. That's the basics. Now, what's a double calendar or a double diagonal? A double calendar or double diagonal is where you're doing a call calendar and a put calendar at the same time. We're just doing two calendar spreads at the same time. Same thing with diagonals. You're doing a call diagonal and a put diagonal at the same time. That's what makes a double calendar and double diagonal. And you go, well, that's not that hard. I can do that. Well, yeah, you can. And we're going to show you that. But one of the implications is it changes what that risk profile is going to look like. So instead of something like this, what it's going to look like is something kind of like this. Okay? And it's going to sort of depend on what strike prices you pick, because sometimes it can be more pointy, higher peaks. Sometimes if you spread them out too far, it's going to, not too far, but spread them out a long ways, it could look something like this, where actually the middle actually dips down below our break-even line. But this is kind of what we're shooting for typically in this class, at least, for a double calendar or a double diagonal. It doesn't matter whether we're starting with a diagonal or starting with the calendar. Once you make it a double calendar or double diagonal, this is kind of what it looks like right here. And we'll see that in just a little bit, okay? So that's the first thing I wanted to show you on this. Now, what I've been doing for each of these strategies that we've talked about over the past several weeks is we've talked about we laid out some rules, some ground rules, and then we looked at the practical application. So I just want to lay out some ground rules here. So what's a double calendar? And I'll do a little double calendar, double diagonal. Number one, we're going to combine two calendar or diagonal spreads. Okay, one call and one put. Okay, so that's the basic of it there. Okay, we're going to sell the near term expirations, and we're going to buy longer dated expirations. Okay, so that's fine. That's the same. That most of these rules are going to be the same as for just a single calendar. Most of the things we talk about that. Okay, now what's the difference between these? Typically, not always, but typically we're going to have a wider range of say profit area, wider range of profit than with a straight calendar or diagonal. But one thing we always say with calendar spreads, or calendar spreads in particular, is they're not directional, okay? Because on a calendar spread, you generally pick that strike price where you think the stock's going to go. Here, we're not going to pick strike prices the exact same way, and we've maybe have a little bit more wiggle room there, but it's not going to be strongly directional there on that trade. So there we go. Like calendar spreads, like diagonal spreads, positive theta, okay? Like calendar spreads, like diagonal spreads, positive vega, okay? Yeah, they kind of offset each other, and vega usually is not a huge factor on this, but it is helpful in positive vega if the implied volatilities go up there, okay, on that trade. Now, and these next couple are really general guidelines that we use in this class, but you'll see if you watch me, I actually violate them quite a bit. So the short options, we're going to target 20 to 40 days till expiration. And that's why I'm not going to call these rules. These are just guidelines for this class that we're going to use here. And we're also the long option. And I realize a lot of times on these long options, I say, well, I give a particular days. And in fact, I've done that in the past. Let me just say this. Maybe a couple weeks past the short expiration, okay? We want a separation from those two. That's what gives them the potential for that time decay, really, is the separation between your short strikes and your long strike. Let me see if I can I wrote some notes down. I want to make sure I get these in the right order here. Let's see. Okay, what strikes do we pick for a calendar? For double calendar, we're going to pick strikes near expected range. In other words, if we think the stock is going to go, here's our stock, okay, and we think the stock may go as high as here or down as low as here, we're probably going to pick strikes for that calendar that are kind of up in that range. They don't have to be all the way up to that range, because the break even will typically be beyond the strikes that we pick. But we'll pick a strike that's up close to that range there, and a strike down here. They don't have to be exactly there, but that's kind of how we're doing it. Whereas with just a single calendar, the strike, we would probably just pick something right in the middle there. Okay. So there we go. So that's your double calendar strike selection. That's how you're going to choose your strikes there. For double diagonals, we're going to usually sell, 30 to 35 delta. We're going to buy, 60 to 70 delta. Again, these are general guidelines. Delta tells you how much an option is going to move in relationship to the underlying move in the stock price, but we can also use it to try and find strike prices here. This is what we're doing there on that, okay? Like single calendars, like single diagonals, generally slow-moving trade, okay? So it's not a swing for the fences, home run type trade, and it can tax your patience a little bit there. The probabilities, a lot of times with calendar spreads, I say, calendar spreads not super high probability typically. They really depend on strike selection. So I can't make an overall super big generalization on that. We're going to exit or roll at 25 to 50% of max gain. Those max gains can be very hard to achieve at times. Let me just scroll this down just a little bit there so you can see. We're going to exit on technical breakdown. And we're going to exit less than 10 days. We'll go 10 DTE. Okay. And then the last one is for money management. And for money management, we're going to do 1 to 2% of active portfolio. Okay. So there we go. So those are the rules. If you want to write those down, you're welcome to. I can't send this out, but you can do a screenshot or whatever you want on that. But I want to look at some examples here and make this as practical as possible. And let me do that as I switch over. Let me move this off. We may pull this back over here in just a little bit. I want to look at trades, and these are more neutral type trades. These are relatively non-directional trades. So let's do it. Let's find some stocks that are more neutral-ish. You can go through a watch list. You can go through a scan if you want. I'll do that one of these weeks. We'll talk about scans. But very often I'll just take a list of liquid stocks, S&P 100 or something like that, scroll through and look for something that's a little bit more in the neutral camp from a technical standpoint. And of course, there's other ways to do things other than technical analysis. But here's Coke. Can you see why maybe I'm calling this a little bit more neutral? I don't know. I don't know where this stock is going to go. But lately, we haven't been getting new highs or new lows. We've been pretty much going sideways on that. All right. Now, let me just check questions before I get to actually doing our double. I want to do a double calendar here. Look at a double calendar here to start on this, and then we'll move on. And Barb's doing a spectacular job in the chat as always. So therefore, let me just see if there's anything that she hasn't been able to get to. Okay, Zanzin, is a 20 to 40 day expiration on short option, is that if you're doing a calendar versus non-IV play earnings? Okay, so the question is, why 20 to 40 days there? So on the short option, remember the short option is the one that takes advantage of theta. So this is not particularly for earnings types plays. So earnings is kind of a special category we're not talking about here. But why 20 to 40? You're trying to maximize theta, time decay, and also have enough time for that to be, for that time decay to actually make a difference. In other words, we could do a 2-day calendar spread where we have high time decay, but then ultimately it's just basically speculating on 2 days worth of stock movement in that case, because we're not really gaining that much just from the time decay for just 1 or 2 days worth of trading. So we're trying to do a balance there on that. Now, sometimes do I go below 20 days? Absolutely. Or above 40? Yeah, I do absolutely on these, in these classes here. But that's the reason. We're trying to balance that out, Zanzin. It's a good question, though, the 20 to 40 days. So often when we do short options, I don't care whether they're doing calendars or short verticals or just a short put, when we're selling options, you'll notice, not just me, but a lot of coaches will go out about a month on those for that reason. Okay, so let's go and take a look at this. Now, if I were going if we were looking more neutral and just doing a single calendar spread here on this, we'd probably be looking at something kind of right in this range for our strike. But the first thing on the double calendar is we want to kind of think of our range here. I'm going to call this the upper bound of our range. Now, stock can go above that, no doubt. And I'm going to call this kind of the lower bound of our range, where I'm considering this kind of a support level and this kind of a resistance level. That's my first task, okay? That is my first task. And so let's do that in mind. So just kind of keep in mind 74 and what is that? That's about 68, 69-ish area or something like that. So let's look at, I'm just going to go to the trade tab and I'm going to go out and we'll look here. And of course, liquidity is an issue here on these. And one challenge that sometimes you may have, and this is something that I run into on these quite a bit, is I may pick strikes here on, say, a weekly contract. Let's say I pick and go, oh, I want to do a 72 strike or a 71 strike. And then I go out and go, well, I want to go out 56 days on this. And I look, and there is no 72 strike or 71 strike, okay? Because when you look, weekly options typically have strikes that they have, and the monthly options often have kind of a different strike schedule, so to speak, of what's available to you. Weekly options often have the $1 increment. Well, these aren't $1 increments. These are $2.50 increments here. So if you're trying to match them up, you may want to, sometimes you have to stick weekly with weekly instead of going weekly with monthly options. Okay? I'm hoping that kind of makes sense. I'm going to start out here going out 21 days. Okay, June 13th. And remember our range. We said kind of the 68, 69, and we said around 72, 73 or something like that, I think. So I'm going to go here and I'm going to do calendar spread. I'm going to do 2 calendar spreads. Well, do you remember how to do a calendar spread? Well, a call calendar, I'm going to do out of the money here, and I'm going to go out, we'll go out to about a 73 here. That's about a 36 delta there. And I'm going to sell that one. I'm just going to click on the bid price to sell that. Okay. There we go. That's the first thing I'm going to do. Now let's go and let's look at the put side of things. Put side, I'm going to go down and I'm going to go to about a 70 put, and I'm going to do a similar thing. I'm going to hold down my control key so I don't overwrite the other one. I'm going to sell this one too. I click on that. Now in the chat, Ted said, if the increments don't match, can you just kind of make them off a little bit and make it a diagonal? Yes, you can, but I'm trying to demonstrate a double calendar here right now, so I can't do that in this particular case. But yes, yes, you could do that. So that's a good question. Good comment there on that. Let's see. Chris says, would you say double calendar is a long alternative to a short iron condor? Yes, although keep in mind there is a Vega difference between the calendar and the iron condor. Iron condors are negative Vega, calendars are positive Vega. But yes, they're pretty similar there in that case there, Chris. I would agree with that on that. Okay, so there's my short strikes. Well, I'm going to go out my long strikes. I'm going to go out, and now for the reason I stated before, I mean, I could go to July 18th, but I'm going to stick with weekly. So I'm going to go to July 3rd contracts here on this. And I'm going to pick the same strikes. I picked a 73 call. So I'm going to go to my calls. I'm going to pick that 73. In this case, I'm not selling it, I'm buying it. So I'm just going to hold down my control key, click on that ask price. And I picked a 70 put. And I am going to buy that one, ask price. I'm going to hold down my control key, and there we go. Okay, so let's just take a look at what this looks like. I'm going to right click on this and I'm going to analyze this on our risk profile tab. There we go. So that, that's kind of what that looks like there. Now, could I change the strikes a little bit, and is that going to give me a different profile? Yeah, that will, no doubt. Let me just hold on one sec. We said we have a June 13th, so let me go to June 14th. Actually, I got that there, and let me go to set slices to break even here. Now, so here's our break even slices. We'll say about 69 and 74. 69 and 74, okay, are our is our break even. So you got to make sure that matches the chart. 69 and 74. From a technical standpoint, we say here's our break even there, about 74, and our break even's right roughly here around 69. From a technical standpoint, do you believe it's going to stay within that? If the answer is yes, this would something you may consider. If the answer is no, then no, you would not consider that. But you can always tweak these, can't you? Yeah, we can tweak these. So let's tweak it just a little bit, and you can play around with it a little bit. Let me go to that Analyze tab and see if I go up here, and I can say, well, instead of 73, what if we widen this out a little bit? Let me just jot it down real quick. So we said 69 and 74 are our break evens right here. What if we tweak this out a little bit? I'm going to go to 74 instead of 73 strikes. See what happens. 74, 74. And we'll widen it out here on this side. I'm going to make this a 69. So we're going out one strike wider on the calls and the puts. Now, do you see how the graph changed? Okay. Now, what I can do is let me just reset this, set my slices, break even. Now, where's our break even? Well, our break evens are actually, so it's kind of interesting because we actually have this, a little itty bitty, there's potential for a small loss if it hits right smack in the middle. But our break evens, now our break evens are like 75 and 68. So we've widened them out further from us. Now, if the stock stays in the middle, yeah, we have that problem. Before it didn't look like that, right? Before it kind of looked like, I'm not going to get this exact, but it kind of looked like this is what it looked like before. Do you see how that shifted? My gains in the middle went down to actually a little loss there. My peaks went out a little bit wider. My break-evens went out a little bit wider on that. And I neglected to, oh, you know what? Gazelle said, can you unlock the price? You're absolutely right. I need to unlock that price because that may not even be accurate right there. Let me do this. Yeah, actually, by unlocking that price, thank you very much, Gazelle, on that. We actually don't have that loss area. It's insignificant gain probably, but we don't have that gain there. The break evens are the same, basically, roughly, 68 and 75. So if we widen it out, but if the stock is kind of in the middle here, then we actually don't really want it to stay in the middle. But the reality is, you can say, well, just my luck, it stays right in the middle. That's possible, but more than likely it's going to go to one side or the other. So that, to me, that's not that big a problem to do it that way. But this dips down lower. So the closer the strike prices are, look, if we have just a plain old vanilla single calendar spread, it looks like this, right? One little peak in the middle. If we do them wide like this, then I'll do this in, say, a blue color, okay? Well, if we do them wide like this, it's like that. If we do them not quite so wide, I'll do it in kind of a red color, then what it's going to look like is something I'm not going to have this exactly right here, but it's going to look something sort of like that, which is the trade configuration that you want. I don't know. It just depends what your forecast is. So there you go. Now, if I want to shift the whole thing to make it a little more bullish, I could do that. I would just increase these prices. Maybe I'd do 75 and 70, okay? Or if I want to make more bearish, maybe I'd do 73 and 68 or something like that. So those are kind of three possibilities there for you. The single calendar in yellow, the double calendar with strikes that aren't that far apart in red, which are going to give us a little bit higher potential gain, but a little lower probability, or the blue which is wider strikes, which is what we did, which is going to give me a higher probability trade, but maybe a little less potential gain on that trade as well. So you can do that. And if I wanted to, well, let me go back here. And maybe I'll do that wider one, 74 and 74 and 69 and 69. And the point here I wanted to make there, because it's fine either way, but throw it on the risk profile and then play with it, tweak it, and see what meets your forecast the best. Okay? So let's, now, what about exits? Well, what do we say on our exits? We're going to exit if it gets down to 10 days before expiration. Okay. I'm going to exit. I'm looking to exit if it breaks maybe above a resistance level. So I'll say, maybe it breaks above the 74 level up here. Okay. I'm going to look to exit here on this. Maybe it breaks below the, we'll say 68 level down there. Okay. Now, if it immediately goes up above 74, we're not going to be at a max loss probably. If it immediately goes below 68, it's probably not going to be at a max loss. Similarly, if the stock stays right in the middle, we're not going to be at a max gain either. We got to, this is a time dependent trade. Okay. So 74 and 68. Let me just jot that down so I don't forget that. We're going to look to exit that trade. Okay. So I'm going to create and do that, make it a first trigger sequential order. I'm going to right click on it. I'm going to create an opposite order, one to get me out. I'm going to make that market good till canceled. I'm going to click on my little gear over here, and I'm going to go down here. We're going to say, well, we're going to get out on if we go above. This is why I wrote it down, because I forgot already, 74, or below 68. All right? Click enter, and there we go. I'm going to save that, and we'll just keep an eye on that. All right? So I'm going to confirm and send that trade. We'll put that in our calendar diagonals butterflies bucket, because I don't have a double calendar bucket there. Make sure you read the red notes down here, by the way, on this before you submit that. And remember, short options can be assigned early. Okay, so we just that's filled right there. So there's a double calendar. Now, what about a double diagonal? Well, again, when I talked about calendar spreads, we said, well, calendar spreads, if you're doing a single calendar, it's kind of a neutralish trade. If I do a double calendar, it's still kind of a neutralish trade. But with a diagonal spreads tend to be a little bit more directional. We've seen this last week. You can review last week's session and you'll see a kind of a directional calendar spread. Let's do another stock though, because what happens is on these is, even though the in case of a diagonal spread, the risk profile looks kind of like, I'll make it more bullish one, looks kind of like this. When you do two of them and you do that double diagonal and you look at that risk profile, it's going to look pretty similar. Again, it depends on the strike prices you choose. It's going to look pretty similar to that double calendar, actually, on that. Okay. Now, Chris in the chat said, TOS is calling that a double diagonal. Yes, it does do that, Chris. Okay, so yeah, whenever you do a double calendar on this, Thinkorswim labels it a double diagonal. I don't know why it does that, but it does that. But keep in mind, if we're doing the same strike prices, okay, both puts are the same strike prices and both calls are the same strike prices. Sorry, that didn't come out right. When your long call and your short call are the same strike, and your long put and your short strike put are the same strike, that is a double calendar, even though Thinkorswim is going to try and mess with your head and say it's a double diagonal. Okay, so good. I'm glad you pointed that out, because I've neglected to mention that, and we do notice that occasionally. Okay, let's look at Starbucks. Starbucks, I'm taking another neutral approach to this trade. Again, maybe you're not neutral on this, but in my mind, we had a pretty sharp downward period here. This is just kind of a basic technical approach. Pretty sharp downward period, but since this point, since our low of beginning of April, we've held our lows. Our highs really haven't gone very far either. So we're kind of in this range right here. I'm going to take this to be a little bit more of a neutral-ish type trade here. Now, going back to kind of the rules that we typically use in this class with diagonal spreads, I'm going to go out and I'll go out 20 to 30, 20 to 40 days on my short options. And I'm going to go to, for my short options, I'm going to do somewhere near a 30 to 35-ish delta. Okay. So I'm going to go and I'm going to look to sell that one. I'm going to click on the bid price. I'm going to do the same thing on the puts. I'm going out of the money, round the 30 delta. We'll go to 82 on that. I'm going to hold down my control key, click on my bid price. Now, I'm going to go out. So what did we just do? We just did, let me just write 82 and 88. Let me jot that down real quick so I don't forget. 82 and 88. Now, I can go out here and do 82 and 88. I could also, I could go out to 56 days. Now, look, in 56 days, I don't have an 82 and 88. That's fine. This is a diagonal spread. Unlike the calendar, and this was I forgot whose point it was earlier, somebody made a good point, and that was, you know what, you can just go out to the monthly contracts and make it slightly diagonal. Yeah, I didn't want to do that on the calendar spread, but on this, I certainly can do that. But you got to make sure they make sense. If I'm looking for something with a delta between 60 and 70 or something like that, and I don't see it, then I may have to go to something with more strikes. Those weekly contracts typically have more strikes. But in this case, here's what I'm going to do. I'm going to go to let's go to an 80, 69, that works. I'm going to go to 80. I'm going to click on the ask price. Okay, I'm holding down my control key. I'm going to go to my puts. And on my puts, I'm going to go to something kind of 69 delta. I'm going to click on this, hold down my control key. And now what I'm going to do is I'm going to right click on this and I'm going to analyze a trade. Okay. There's my trade. Okay. So do you see, this looks pretty similar, right? Now, if I could, this could easily look like a double calendar, right? Doesn't dip down that much in the middle, but this is basically they look pretty much the same here. And what did I want to do? Oh, I wanted to do, let's do this. Let me set my slices to break even. And so it's a slightly higher probability trade, 54%. But we're still going to have our exits on this trade. And we'll still look for our exits. So what are our exits on this trade? And well, of course, ask yourself, we're going to say our break even is about $80. It's a little bit below that, but about $80 and about $90. It's a little bit above that. 80 to 90 is our kind of our zone here, our zone of happiness. 80 to 90, right in there. 90, 80. Does that make sense? Well, yeah, I mean, that seems to be the range. We could possibly look to push that down a little bit if we wanted to, but that's kind of that. And if it breaks a little bit below that, doesn't mean we're going to be at max loss or anything right away. But that's that. This stock is just kind of going sideways. It's kind of languishing, if you will. And so there's that trade. Let me go and let's talk about exits. Okay. And let's talk about exits. Is the break even calculated off the short leg or the long leg, Gazelle asked? It's off both. It's off the entirety of the trade is where the break even is calculated. Okay. Now it's the break even at expiration of the short leg. Okay. Because once the short leg expires, then you don't have a diagonal spread anymore, right? But it's looking at that snapshot in time when the short leg expires, but it is looking at the entirety of the trade there. So good question there on that. Let's go and talk about our exits. Well, where do we say we're going to? Well, I'm going to say I want to exit if we break out above our upper end here, which is going to be, what is that? About 88. Maybe I'll give it a little wiggle room above 89. Above 89, if we break above our moving average, maybe we'll call that an 89 exit. What about on the downside? Well, if we break down below here, about 76, we're going to exit this trade. Right. Again, we're not just going to exit in that case. We'll also exit if we're under 10 days till expiration, if we've made most of what we can make on this. This is starting with about 1157. We'll call it 1160 debit. If we could make, about, $600 on that, that would be a reasonable exit too. Even $500 would be a reasonable exit. That'd be a little less than 50%, but that's okay. I'm going to click on first trigger sequential. You can do, by the way, you can click first sequential all. It doesn't matter if you only have 2 orders. If you only have 2 orders, it doesn't matter. It's once you add the third one in, the difference between the first triggers all and the first trigger sequential. I'm going to create an opposite order. I'm going to make it a market order. I'm going to make it good till canceled. And I'm going to click on my gear. And we're going to say we're going to get out if Starbucks marks less than or equal to, I jotted it down, 76. Or if Starbucks marks greater than or equal to, so that's the range we need it to stay in, 89, 76 to $89. And there we go. We're going to save that. Mid price on this, 1152. We may need to go up to get that filled a little bit. We'll do that. And I'm going to confirm and send. Remember, short options can be assigned early. And we're going to send that trade. And it's thinking, hasn't filled. We'll see if that fills there. By the way, if it doesn't fill and you want it to get filled, you can always go up here. You can go to your working orders. You can right click on it and you can cancel and replace that order and say, I want to tweak this up a little bit and make sure this gets filled. Send that. And there we go. That now it filled on there. Okay. Max loss is the initial debit. That is correct there, Ted. Max loss is the initial debit on calendar spreads and diagonal spreads there. Okay, that's it. You see, it's not super complicated. Once you know what a calendar spread is, it's easy enough to just do 2 of them. One call calendar, one put calendar. You got a double calendar. We call it something different. Instead of putting it right in the middle strike, you could actually do both the call calendar and the put calendar at that middle strike. And it doesn't typically look that, it's not that far off of what we're doing here. But typically we're going to spread them out a little bit. Same thing with the diagonal spread. Just use your rules for a single diagonal, for your call diagonal, and do it at the same time you do for a put diagonal. And you got your double diagonal. Okay. Thanks everybody for joining me today. Appreciate you. Coming up next, we have, I do this every week, I should remember, ThinkScript Studies. ThinkScript Studies. Mike Fairborn teaches that class. Great class. Make sure you check that out. Thank you, Barb, for helping me out. Calendars, last question, Gazelle. Calendars are sold or bought? Calendars bought. We're buying, these are both debit spreads. Calendars and diagonals. When we put in a closing trade, we're selling them to get out of them. Okay. All righty. Hey, it's a holiday weekend, everybody. It's Memorial Day weekend. So have a nice weekend, and we'll see you next week. Bye-bye, everybody.